So have you inherited an IRA? You're the beneficiary of an IRA. What's the tax? That's today's cardinal lesson. And it's more complicated than you think it is. I mean, one simple solution, let's say you inherited an IRA of $200,000 and it's a traditional IRA and you've received it, you've talked to the financial advisor. And so one option for you is to pull the whole 200 grand out and then add that 200 grand to your otherwise income. Let's say you make $80,000 a year. So now this year, your taxable income is going to be $280,000. And we're going to have to pay tax at $280,000 rates. So we're going to take about 40% of the IRA of the $200,000, or about $80,000, send it to the government. You're left with 120 grand free and clear. That doesn't sound too good, does it? And so, unfortunately, that's what some people do. Now, there are ways that you can spread this out over a number of years. And there's laws, there's regulations, there's a whole bunch of stuff. That's what this video is about. So, Drew?
Thanks, Hans. Tom, why are we making this video today?
Yeah, we're doing this video because you've just inherited an IRA, a traditional IRA, or 401k. They follow the same rules, and you don't know what to do, right? You don't know what the rules are. You don't know what the tax implications are, and you're at a loss, right? And you just don't know where to go. And so what we want to do today is go over how the rules work, what category you fall in, because there are different categories for beneficiaries. We'll get into that in the video, and what rules each category has to follow. And if you're the IRA owner and you're watching this video and you're thinking about leaving money to sort of the next generation, you need to know what tax implications and what rules they have to follow, because this might not be the best account to leave to them. There's things that you can do today to leave it in a better spot for your kids, because unfortunately, a lot of times, and this might be you, have most of your money saved in an IRA or 401k, and you're not living off of it. You have other money you're spending for income, which is good, right? I mean, that's always nice. And this is the money I'm going to leave to my kids. This is sort of the legacy money, which works. That's where most people are. It's not the best way to do it. And we'll get into that as we go through the video. So let me bring up the show notes. You can find these at the link below our video. They're also on our website at cardinalguide.com. These show notes are very important. All our show notes are important, but these ones especially, if you're inheriting an IRA, I want you to print these out. I want you to study them. And then if you can't make sense of them, call us. Call somebody who knows how these works, because mistakes happen all the time and they can be very costly. You can pay a lot of taxes. So we want to avoid mistakes here. So first show note, these are sort of 6 questions. We'll get to each question here in a second, but this really helps identify what category of beneficiary you are. So you can sort of follow through on that. These ones define the rules, pretty quickly, and we'll sort of expand on these as we go through. These define the different rules that each category of beneficiary has. So depending on where you fall in this, you follow different rules. And then this is the life expectancy table that is used to calculate RMDs, if you have RMDs, and we'll get to that also, of how you do sort of the RMDs on inherited IRAs. This is not the chart for your own IRA. This is only for inherited IRAs. So very helpful show notes. I actually have these charts printed out on my desk every day. I refer back to them all the time. So I think this is certainly a very, very helpful show notes here. So Drew?
Hans, before we get into the details, can you briefly list the different categories that a beneficiary can fall into, but then lead it into what information do we need to gather first as financial planners?
Okay. Well, the first thing we need to do with these 3 categories is we determine, did the decedent pass before 2020? Because the Secure Act went into effect in 2020 and after, and that invented the 10-year rule. And before 2020, everybody was an eligible designated beneficiary, category number 3, and they could stretch the payments out over their lifetime. But when the Secure Act was passed, it had a lot of benefits for IRA owners, but this was not for the inherited people. This was not a benefit. one of the things they put in there was the 10-year rule. So that's the first thing we need to know is we need to know but assuming if you're watching this video, you just inherited an IRA, the first thing we're going to need to do when we're advising you is determine which of the three categories of beneficiaries you are. And so I'm going to briefly go over that. Number one is the non-designated beneficiary. And real simple, if you're watching this video, you're not a number one. You're not a non-designated because these are not people. This is where the decedent left the IRA to a trust, or it went into their estate, whether it was directed there or not. So anytime you have a beneficiary that's not a person, not a real live person, they're in category number one. Okay. Now, category number two and category number three, if you really wanted to pick which one of these is better, I'd rather be a category number three than I would a category number two. Okay. Unfortunately, most people fall in the category number two, which is the non-eligible designated beneficiary. The government, when they're writing the laws and the IRS, they don't make this stuff easy. So, I'm going to tell you first what a non-eligible designated beneficiary, you're not eligible for number three. So if you can't qualify for number three, they push you back into number two. And it's just real simple. And most of the people that fall under this number two are the adult children of the deceased. I mean, they're just, mom or dad was 87 years old, passed away. I'm the 60-year-old son, and I inherited the whole thing. I'm going to be a category number two. I'm going to be a non-eligible designated beneficiary. I fall under the 10 rule. Okay. Now, category number three is going to be probably the biggest category number three people are surviving spouses. And most people, when they're a married couple, they leave their spouse as the beneficiary, and the spouse is going to get the most favorable treatment from the IRS. So the spouse can do a lot of things. They are an eligible designated beneficiary or an EDB, but then they qualify for the most favorable treatment, which we'll get into in a second. But there's also other people that qualify, minor children of the decedent. So when somebody dies and they leave their IRA or part of their IRA to a minor child, they are eligible EDBs. The disabled people. So if you leave your IRA to your adult children, that 60-year-old son, adult son, but he's disabled, he qualifies as an EDB by being disabled. So that's going to be beneficial to him, possibly. Then you have the chronically ill. So somebody who is needing really essentially long-term care. They qualify under the chronically ill. So you leave your IRA to your sister or your son who needs long-term care, or daughter. It doesn't matter who it is. If they're chronically ill, they're going to have the same benefits as a disabled person or a minor child. And then individuals who are not more than 10 years younger. So whatever, I kind of went into a longer explanation when your question asked for a short one. So you got three categories of beneficiaries: non-designated beneficiaries, non-eligible designated beneficiary, and eligible designated beneficiaries. And all of these dictate the terms that you've got to pay this IRA out to yourself, with this having the most favorable terms, this being the most common and having the 10-year rule, and this having the most strict payout rules. Drew?
Thanks. Tom, can you go over the 6 pieces of information that we need to collect to start identifying which category a beneficiary of an inherited IRA belongs?
Yeah, and you'll find these sort of on the right, sort of bottom section of the board, and they're also in the show notes. In the show notes, a little bit longer explanation, but the first one is, when did the decedent pass away? So year, date. The date is not as important, but it can be, and I'll get to that in a second. But especially, I mean, really the full date of death is really important. So when did they pass away? Second one is, what was their date of birth, right? That becomes important, right? Because as some of these rules we'll get to in a second, depending on when they were born and when they died, you could be in the same category of like non-eligible designated beneficiaries, but follow different rules. And they get, again, this is confusing. Like Hans mentioned, they don't make this easy. And there's a lot of advisors out there don't really understand the nuances here. So you need to be careful when you're getting advice here, because some people, they've heard about the 10-year rule, they throw out the 10-year rule, which is the most common, but it's not always the same 10-year rule. So we can be careful here. Number 3 question, who or what is the beneficiary? The what is really talking about category number 1. Is it a trust? A certain type of trust can fall into category number 2. But for right now, we'll say trust in category 1. Estate, this is a common one I see. People just list their estate as the beneficiary. Maybe they don't know who to list it when they first set up the account, and they list their estate and never go back and change it. That's a problem. And so if you're in category number 1, again, you need to, I guess you don't need to be, you wouldn't be in category 1. But if you're the owner and you're naming category 1 beneficiaries, that can be a problem there. A relationship with the descendant. So are you a spouse? Are you a child? Are you a sibling, right? That becomes important here. And then we get into sort of information about the beneficiary themselves. So the date of birth of the beneficiary becomes important in terms of calculating RMDs. We'll talk through the rules in a second. And then whether it's a Roth or traditional, right? So if Roth money, you inherit tax-free, which is nice. You still follow some rules here we'll get into, but there's really no tax implications. Traditional IRA, that money is going to be taxed at some point. So you got to be really careful of making sure we're taking it out in the right order, the right time frame. The goal trying to be to minimize the taxes as much as possible so you can keep more of that inheritance if you're inheriting these accounts. So those 6 questions, when we have the answer to all 6, we can place you in one of these 3 categories. And from there, we can follow the rules that each category has. Drew?
Hans, category 1, non-designated beneficiary, NDB. So not who, but what beneficiaries fall into this category? And then can you explain what RBD means written under that?
Yeah, that's required beginning date. So that's very good. We'll start with that. I'd have to use some abbreviations on the board, or I'd need 2 boards. But the required beginning date, this is real key. And it really goes back to this question of when did the decedent pass away? And then the date of birth of the decedent. So if for instance, if a person, like if I died, I'm 67 years old, almost 68. So my IRA, I haven't reached my required beginning date yet. That's the date that RMDs, or required minimum distributions, start, which for me would be age 73, and it'd be April 1st of the year following the year I turned 73. So that'd be well into the future. What an inherited IRA wants to know is had the decedent started required minimum distributions or RMDs yet? And if the answer to that is yes, if they've reached their required beginning date, then you're going to have a whole set of rules around money you got to take out right beginning the first year, okay, and the second year and the third year and the fourth year, all the way through the 10-year period. So that's what RBD means. Now, your first question was about this category number 1. Ask me that question again, just so I can.
I was saying not who, but what type of beneficiary ends up falling into this category.
Well, this is when, as Tom said, this is somebody that just listed as their beneficiary the estate of the insured, or a lot of retirement plans, they default to the estate. If the person never listed a beneficiary, or the beneficiary is deceased, that they did list, then it's just going to default to the estate of the insured, or the estate of the owner. And that's definitely going to be number 1. Other people, I have a client, she's a client, who her husband left this very large IRA to a trust. Okay, I mean, he didn't name the trust as the owner while he was alive. That would have been a real mistake. But what he did is he named the trust as the beneficiary. And he died 3 years ago. So, of course, they just titled the account the name of the trust. And so she, as the beneficiary, or the trust is really the beneficiary, she's automatically thrown over here into number one and she's going to have the least favorable rules for payout. Unless we can get that trust declared a look-through trust. So now you got another whole set of rules where, because that trust names her as the beneficiary, but it's not really clear whether the attorney did this correctly way back before he died. So I don't want to get into a lot of details. What determines, it's real simple. These are not people. So when the beneficiary is named something other than a person, it's a category number one. It's a non-designated beneficiary. If the beneficiary is a person or persons, it's going to be either number two or number three. Drew?
Moving to category number 2, non-eligible designated beneficiary, or NEDB. Tom, you and Hans mentioned that most of our viewers are probably going to fall into this category. Can you give us some details about what exactly this means for an inheritor?
Sure. And then I'm gonna make one more comment on category 1, and then we'll get to category 2. So on category 1, so we now know that it's not a person. Let's just use the estate as the example. So you listed the estate, the person passed away. Now we get into sort of what are the rules they need to follow, and this is where the RBD, sort of the date you asked about, Hans, earlier, the required beginning date, is important. So have they started RMDs yet, or have they not? If they have started RMDs, now we get into, that's the second one here, passes after RBD, and it's this ghost life rule. Essentially, they have to continue taking the RMD schedule as if the owner was still alive. Gets pretty confusing. If you're in this situation, call us. We can walk you through piece by piece. Or in the first option is they passed away prior to RMD starting. This is where this 5-year rule comes into play. That account has to be exhausted, emptied out over a 5-year window of time, and then it needs to be gone. So again, a much more accelerated payout schedule, much higher taxes. So that's sort of category 1. Category 2. So again, this was the new category that was introduced within the Secure Act. Again, it's a non-eligible designated beneficiary. Most commonly, these are your children or grandchildren, right? You're passing it on to the next generation. I guess spouses are pretty common beneficiaries, and so we'll get to that number 3. But assuming we're passing them on to the next generation, kids generally, they fall under this non-eligible designated beneficiary category. So you'll look, it's kind of everybody other than category 2 or 3 is really how it's defined, right? So you have adult children, grandchildren, certain types of trust. If the trust is written correctly, it could fall under category 2. And so that's where the bulk of sort of the eventual beneficiaries of the accounts are. Now we get into the same idea of the RBD, so required beginning date. This is April 1st following the year you either turn 73 or 75, depending on your age. We have other videos that we go over the distinction there. But if you die before your RBD date, required beginning date, meaning you have not started RMDs yet, I'm talking about you as the person who deceased. So if you're the inheritor of the account, so I'll just use myself as an example. Let's say my mom passed away and she had not started RMDs yet. I inherit the account. Now I don't have to continue those RMDs. Since she hadn't started RMDs, I have no RMDs over those 10 years, meaning I could leave the money in the account for those full 10 years. But by the end of that 10th year, that account has to be empty. The 10-year rule, that's what we're talking about, is what that says is 10 years following the year of death. So if my mom, which she has not, but if she passed away in 2026, the 10-year clock starts 2027. So you count 27, 10 years later. By the end of 2036, that account would need to be empty. No more IRA left. If she had not started RMDs yet, or she passed away before her RBD date, then I'm not required to take any money over those 10 years. The problem with that is some people say, great, I'll just leave it there. I don't need to worry about it. I won't take it. Well, let's fast forward to the 10 years, the end of the 10th year. What happens is now I have to take that full account, throwing me into much higher tax brackets. So in reality, even though you don't have to take money out, you probably should take it out over that 10-year window of time. Again, the timing of it, some people take it evenly, some people sort of mix and match depending on if they're close to retirement date. It gets complicated. Again, call us. We'll help you walk you through that. More commonly, so again, this is people who essentially have passed away prior to their early 70s. More commonly, people are making it past that point. Now they have died after the RBD date or when RMDs have started, right? So they've already started taking their RMDs. So in my examples, let's say my mom had started her RMDs and then she passed away. Then I would have to take RMDs. That's where that single life expectancy table in the show notes come into play. I go to see what age I was when I inherited the account. It gives you a factor. Let's just say, I don't know, 40, just as an example. Now I have to take that account balance divided by 40, and that is my RMD in that year. And then every subsequent year, so that's the starting point, and then the next year you minus 1. So you go from 40 to 39 to 38, 37, 36. So you're doing that. So that's your RMD during those 10 years. But then by the end of that 10th year, the account still needs to be emptied out. So I run into a situation a lot of times where people, they've gotten to the point where they know they're in category 2. They know they have to take RMDs over those 10 years. And then they just take the minimum each year, which they're satisfying all the criteria, right? They're doing everything right. They're not breaking any rules. So there's no penalties or additional taxes or anything owed, which is good. The problem is we get to the end of the year 10 and that account has just grown. It's higher than it was when they inherited it, right? Depending on their age. And now they got to cash it all in at the end of the 10th year. So in reality, just because you have RMDs, you probably should be taking more than those RMDs over those 10 years. Again, very specific from situation to situation. That's not a blanket recommendation. You have to at least take those RMDs. Most often, it makes sense to take more than that over that 10-year period of time. Again, if you're in this situation, call us. We'll help figure out what the best solution for you is. But that's really over category 2. Drew?
Just to follow up on that, Tom, let's say people don't call us or another financial advisor for help on this. Do they need to print out this table on their own and calculate this on their own, or do these custodians or the institutions housing the funds for the inherited IRA, do they help with this at all?
So, I'll give you 2 parts of the answer. The custodians typically will calculate the RMD. Having said that, I see them make mistakes all the time. So I would recommend look what the custodian says. It might be right. I'm not saying they're always wrong. Sometimes they're exactly right. I've seen them, especially when we get into sort of nuanced situations like in category 3. I've seen them miscalculate things. So I always recommend calculating it, by hand with someone who knows what they're doing, just to make sure that you're taking the proper amount out.
Hans, category 3, eligible designated beneficiary or EDB. Talk to us about that, please.
Okay. And again, after I have some follow-up comments on what Tom just said, so the custodians do give you a number most of the time that is under category 2 here, that is your RMD on an inherited IRA. But I'm with Tom. First of all, a lot of times that number is not right because they don't have all this background. And a lot of times that is not necessarily the amount you have to take. A lot of people are going to read that. They're going to say, oh, that's how much I'll take. Well, the reality is you can always take more. And many times more would be appropriate than taking that RMD because you got to keep your eye on this tax bomb that's going to hit you at the end of the 10th year. So we've just taken on an additional software. We've had several software in the past that specifically addresses this. And you can go in client by client and they have this thing called distribution smoothing. And, it has a way where we can let the software takes into account tax rates, your income in the future. So just on that, we could talk all day about during the 10-year rule. We've got to take some minimum distributions in some cases, but then again, is that the right amount? Now I'm going to answer your question about number 3. Is the eligible designated beneficiary? This was really the government's way under the Secure Act of saying there are still groups of people that we're going to let them stretch. And what a stretch means is calculate your life expectancy at the time the person died, the IRA owner. You're the beneficiary, and we calculate your life insurance. Like an example I can give you of one of my clients that's an EDB is he was 66 years old when his sister died at 69. So, and she left him a $4 million IRA, all taxable. And it's hard to be upset about that. I mean, that's pretty sweet. And he left her a bunch of other stuff. But immediately he was consumed with the tax issues with this thing. And his advisor had told him that, or her advisor, who was becoming his advisor, said, oh, you fall under the 10-year rule. So he was under the assumption he could do anything he wanted for the 10 years. And the guy was part right that if, as an EDB or number 3, you could just choose the 10-year rule. Say, I want to do that. And the sister, who was 69 when she passed, she hadn't reached her RBD, required beginning date. She wasn't getting, so he could have just left the whole money sitting there for the whole 10 years and then just taken it all at the end. That would have created a gigantic tax bill. So then he was already in the mindset, well, I need to space this out over 10 years. How do I do that? And I said, well, wait a minute. You qualify as an eligible designated beneficiary because you are her brother. And it didn't matter whether they're brother or not. He's not more than 10 years younger. He was 66, she was 69. So he now is able to take and distribute this IRA over his life expectancy, which takes him to 86. So his life expectancy was 20 years a couple of years ago when all this went down. So he has from 66 to 86 to divide up these distributions, and he has a minimum distribution each year. And that's what you need the chart to calculate. And, you know, that's one of the reasons I just yesterday ran him through this new software that we've gotten. And it's come up with something a bit different than I created for him 2 years ago. And so we're going to switch over to that schedule, and I'm going to have a meeting with him. And you always can take more. But what this did for him is it allowed him to spread this taxation out over 20 years as opposed to doing it over 10. I mean, and that's a big difference for somebody when you look at $4 million. And then an additional point that I learned when I was just out at Ed Slott training with Tom a couple of months ago is the whole idea of a successor beneficiary. So, and I didn't know this before. I thought in his case, because he followed under eligible designated beneficiary, he had the $4 million. He could stretch it over the 20 years. And we've calculated the amount he needed to take in 25, 24, 25, and we're just now calculating 26. I thought that if he died all of a sudden, and then now his wife, I thought incorrectly that she could just finish the 20 years. That's not correct. As a successor beneficiary is going to fall under the 10-year rule. So the successor beneficiary effectively becomes a non-eligible, and then she will have 10 years to distribute, but she will also have to take an RMD during those 10 remaining years because he was already taking RMDs because he's the decedent now. It's a little complicated, and it really just kind of brings out, like if you inherited an IRA, you need to talk to somebody that knows what they're doing and specializes in this kind of stuff. And we work in all 50 states, the District of Columbia. We meet by Zoom. Yes, if this is a big extended thing and it's a lot of money and we have to do a lot of work, we're going to charge you. If it's kind of a small thing, or you've just inherited, but small meaning you've inherited $100,000 or $160,000, we can meet with you, give you some simple answers. We're not going to charge you for that. So feel free to call us and to get in touch or go into the website, and Tom and I or Drew will be glad to meet with you and give you some preliminary stuff. And if we don't have the answers, we have access to Ed Slott's elite IRA experts. And so we can get them on the phone. I could do that in the next hour. I could get one of those people, present the situation, and they're going to give us the correct answer. So, really this whole video is about, don't take this stuff lightly. I mean, if you inherit money from an IRA and you're the beneficiary and you got this money, and some people, if you really need the money, then all this discussion is if you need the money and you need the residual, then you're going to distribute all of it and you're going to pay a big tax, and you're just going to be left with what's left after tax. I mean, that is the simple default solution, and it's not very attractive if you don't need the money desperately. And then at the very least, you could spread it over a couple, 3 years, and you don't need a bunch of rules to do that. If you inherited $120,000, you could take $40,000 immediately, $40,000 next year, and $40,000 the next year, separated into 3 tax years. That would qualify under any of this. But like most people, is all of a sudden you inherited this, you want to smooth that tax, or you want to, you're going to need to get a hold of somebody that knows what they're doing. And we go to specialized training in this, and we're experts at it. I also want to point out, people, all of us, like all 3 of us, we have IRAs and 401ks ourselves. And, and I think all the viewers, or most of the viewers, you've got that, you're still alive. You can still name beneficiaries. You need to think about this in terms of your children that are going to inherit this, or your spouse that's going to inherit this. Or if you've taken some of your IRA, you're leaving it to your spouse, you're leaving other part of it to your children. You might want to rethink that, because your spouse is going to get the most favorable treatment, some of which is the spouse can actually take the inherited IRA and roll it over into their own IRA. And then they could convert it to Roth. They could do a lot of things. So, I don't want to go back and redo the video. I want you, if you just inherited an IRA and you can afford to spread it out over time, you need somebody like us to give you some consulting. If you own an IRA and you're still alive, and you need to take this type of information into account when you're naming your beneficiaries, and at least give your adult children or spouse or beneficiaries some level of education, or point them to somebody like us, so that when you do pass away, they have some sense about how they distribute the money to themselves and pay taxes on it. Drew?
Thanks a lot, Hans. A lot of really helpful points there. And I'm just looking at this, I get a feeling of, okay, I understand there are varying levels of flexibility here, depending on which category the inheritor falls into. But knowing the requirements or the baseline rules, that's probably not enough to effectively plan for this inherited IRA. And so I'm with you. Work with a professional, whether it's us, you see our number at the bottom left of the board, call us, we'll be happy to talk. But very confusing. They certainly don't make it easy. And some professional guidance can certainly go a long way. So Tom, do you have any final thoughts?
Yeah, so one other sort of thing we didn't hit on a lot, but I want to point out is when you see, so there are people, a lot of money are in traditional IRAs, traditional 401ks, but more and more people are starting to do Roth conversions or contribute directly to a Roth IRA. And so Roth IRAs follow sort of the same rules that we have on this board. The biggest difference is there are no taxes, right? Because the one of the really sweet things about a Roth IRA is all the growth is tax-free, and that gets passed on to the beneficiaries tax-free. One of the things I'll point out is this comes in on category 1 and category 2, when we have these differences about the RBD date, required beginning date. And so essentially just read that as has the owner started RMDs. There are no RMDs on Roth IRA accounts. So by definition, any Roth IRA account would be under the rule of before RBD. So anytime you see on the board where it says before RBD or before required beginning date, that's going to be the rules that you follow on the Roth IRA, because for the original owner, there are no RMDs on the account. For the inherited person, there are RMDs depending on which category you fall into. So just be aware of that. I just want to make that point on Roth IRAs versus traditional IRAs.
Okay, well, what we want to do here is we want to talk about comprehensive financial planning and what we've touched on today. And we haven't talked about really much other than 401k, IRA. We've talked about income, and we've certainly talked about taxes and estates. So we've covered those. I'm Hans Scheil.
I'm Tom Griffith.
And I'm Drew Samalo.
We thank you very much for listening.
Thank you.
Thanks.